Are you self-employed and got kicked to the curb by another lender? Well, we're going to talk about that today on Just Mortgages. So before we get into talking about self-employed borrowers, let's talk about what is a self-employed borrower. A self-employed borrower is someone that owns 25%, 26% really, or more of a business. If you own 25% or less, you're not self-employed as per the lender. So we have a lot of self-employed borrowers that get referred to us that have no place to turn. They've gone to 7 lenders, 8 lenders, and they can't get the loan done. And I said, let me see your bank statements. Because see, most of the time it's the tax returns, right, that is causing them not to be able to get a loan. The lenders don't have the ingenuity to go outside of the box and find other strategies to get a loan done. Well, we at Just Mortgages figured that out. I figured that out a long time ago, that I wanted to be the one to be able to tell people yes more times than no. And so we have, for self-employed borrowers specifically, bank statement programs. But first things first, when you're self-employed, let us take a look at your 2 years tax returns. Because I want to evaluate, I want to see what they look like, I want to see what the ownership percentage is, I want to see the K-1s, you probably know what those are, and if not, your accountant can provide those to us, and we can take a look at that. Let's evaluate first if you're defined as self-employed. If you are, let's assume you are, and let's move forward. Then we're going to need 2 years worth of tax returns, personal and business, of all businesses owned. And the good thing is, which most mortgage brokers do not know, is depreciation that is being deducted on your corporate tax return gets to be added back as income. So that does not get counted against you. That's a positive. So that's the thing that I'm looking for, and I'm looking for tax returns from the corporation. I'm looking to add back depreciation to see if that's in there so I can increase my income to qualify. So that's full documentation. And I'm self-employed just like you are, if you are self-employed, and we write off a lot of things that the employed individuals do not. So what do you have to do with that? So the only way to do it is you can add back depreciation if you're going full doc, or you're going to have to go with bank statements. Well, how does that work? You can use business bank statements, 12 months or 24 months, use the deposits as income, not transfers, but deposits, and we use that as income to qualify the individual. You're going to put more money down than a standard loan, but you end up getting the home. I consider this a glorified bridge loan nonetheless. So it's a bridge loan, has no prepayment penalty on it. You get into the house, and then later on when your business does better and you show more income, you can refinance into a standard mortgage. So self-employed borrowers are unique. We know how to do it. I am a certified public accountant, so I do know how to read tax returns. And it is helpful when we have to explain that to an underwriter. So we always want to make sure that we're doing the best job and making sure it's thorough. So we're going to have to verify the tax returns. So what we have to do, so when we get these tax returns, they have to be verified with the IRS to make sure that those were the ones that were filed. Believe it or not, people actually provide documentation that was not filed with the IRS, go figure. So the lenders require that, federal government requires that, and so we have to abide by that. So if they cannot be verified or they have not been filed yet, then we have to go with the bank statements, because if you go with bank statements, you don't have to provide tax returns. Isn't that a beautiful thing? So we don't have to go through all the hassle. It's a lot quicker, it's a higher interest rate, it gets the job done, and it's a glorified bridge loan to be able to get into that house. How do we verify the down payment? Because the money has to be verified, because a lot of people come in and say, I'll have the money by closing. You can't have the money by closing, you have to have it now. Prior to closing, it has to be verified and sourced to your account or gift funds. Now the good thing about it is that the things have changed in recent past. Now it's gift funds can be all of the down payment. Conventional loans, FHA loans, those are all can be 100% of the down payment can be from a family member as gift. So we have to verify and source that back to it's a one-page letter, it's very simple. It's not rocket science, get that thing done. But let's talk, if you have your own down payment, it has to be in the account for 60 days. If it's not in the account for 60 days, they have to figure out where that money came from. Because again, it's the anti-money laundering rule that requires that any monies that have not been in the borrower's funds for at least 60 days have to be sourced. So if it came out of a 401k, we just show where it came out of the 401k. If it's gift funds, it's gift funds. If it was a paycheck, it was a paycheck. So we show that. If you have mattress money and you run a business, you've set some cash aside, you deposit the money in your account. and let that money age in there for a couple of months and then show us the bank statements, then we're fine with that. But that's how that is done if you have the time to be able to do that. If you don't have enough income to qualify, can you bring somebody in to co-sign? The answer is yes. So we call them a non-occupant co-borrower. That means they don't have to live there, they just have to be a blood relative, and they have to basically be underwritten just like you're being underwritten and show all of their financial information, and they co-sign for you. We have that a lot. We call them kiddie loans, where we have the parents that come in and co-sign for the kids when they go to college, and they buy them a condo, and they call it kiddie loans, and they buy the condo, establish credit for their kids while they're going to college, and then they have some other friends that come in and rent from them, and they end up making the whole payment. I've had clients that have done that, so it's a pretty interesting strategy. So non-occupant co-borrowers can be had, parents, grandparents, brothers, sisters, what have you, to be able to make sure they don't have to live in the property with you. We can also go, when that's primary residence, when we go into investment properties for self-employed individuals, now we're talking about stated income. You can go stated income, and you just state your income. You don't have to verify it, and you also have using rents only to qualify. If it brings $1,200 a month, if we can prove that would bring $1,200 a month rent, you can use that to qualify and offset the payment. So a lot of different strategies. We're the out-of-the-box lender that tries to figure a way to get a loan done and not how to decline a loan, because that's how we operate at Just Mortgages. If you like this video and you're self-employed and need a specialist to get you into your next home, give us a call or visit our website.